In banking, risk never disappears. You either manage it, share it, or you pay for it. In module 2, we talked about understanding risk, defining it, measuring it, and knowing how it impacts the bank. Now we move into the next step, managing that risk. This is where decisions have to be made. Do we avoid it, reduce it, transfer it, or shall we accept it? In banking, each choice has a price tag, not just in money, but in time, regulatory attention, and customer trust. We will look at real world banking cases where poor risk treatment decisions led to financial loss or compliance breaches, and examples where proactive choices paid off. By the end of this module, you will have a clear framework for deciding how to handle different types of cyber and operational risk. And you will see why documenting those decisions is as important as making them. Let's talk about risk appetite and risk tolerance, two terms that pop up in every governance meeting. In banking, you can't eliminate all cyber risks, nor should you even try. Instead, the smart move is to decide what level of risk you are comfortable with and how much variation you can tolerate before action is needed. That's the difference between appetite, that is how much risk we are willing to accept by design, and tolerance, the wiggle room around that appetite before alarms go off. Think of it like this. The bank's board might say, we are okay with up to £250,000 in cyber related losses per year, but the risk tolerance band may be set at plus minus 20%. So anything above £300,000 means someone needs to escalate and treat that risk. This is very real in practice. Under prudential regulatory authorities in UK, on operational resilience, the banks must set clear impact tolerances, especially for critical business services like payments or trade settlements. So when we assess risk, it's not just a technical exercise. We are trying to stay inside these appetite and tolerance thresholds. Because once you go outside them, senior management and regulators must be informed. Let's talk numbers, shall we? Quantitative assessments are great when you need hard data to justify spend. And banks love numbers. We try to estimate the cost of a risk over time. Say your online bank goes down for 6 hours. You factor in, firstly, the lost business, then customer compensation, then comes brand damage repair, and possibly regulatory penalties as well. That gives you the single loss expectancy, maybe about £500,000. Now, how often do these outages happen in a year? Let's say they happen twice a year. Multiply your SLE with 2. That will give you your annualized loss expectancy, ALE, that is £1 million a year. Now compare that to your bank's risk tolerance. If the ALE exceeds your accepted threshold, say £750,000, you are outside tolerance and you must act either to reduce the likelihood or to reduce the impact or reduce both. This method gives decision makers and regulators a defensible basis for prioritizing cyber investments. It is especially useful in banks when seeking budget approvals from the CFOs or reporting to the board risk committee. But of course, not every risk can be quantified. So, qualitative assessments still have a place, which is coming up next. Not all risks come with data you can plug into a spreadsheet. In many cases, especially when dealing with new technologies, emerging threats, or reputation based impacts, we turn to qualitative assessments. That means bringing together SMEs from risk and cyber operations, running workshops, tabletop simulations, or impact scenarios, using guided judgments to place each risk onto a heat map. Let's say your team is assessing the risk of a cloud misconfiguration. No breach has happened yet, but you have heard about Capital One incident. You might classify it as likelihood possible based on complexity and internal audits. And you may classify impact as high due to sensitive data in the affected system. On the table, that gives you a high risk, which may require board level visibility or formal mitigation. Banks often rely on this method for fast prioritization, for governance reporting, especially for operational risk committee. Mapping risk to risk appetite level, it also helps bring non-technical stakeholders into the process, which is crucial in board-driven environments like banking. All right, we have measured the risk. Now what? We treat it. And in banking, this means deciding how best to move the risk back into tolerance without killing the business process. You have got four choices, not necessarily in the order I'm going to speak in. First, avoid it. Just don't do it. This could be rejecting a new fintech integration because the data risk is too high. Avoiding risk can save you, but it often means walking away from opportunities as well. For example, in year 2019, some UK banks decided not to launch certain cryptocurrency linked services despite customer demand. Why? The compliance and fraud risk were judged too high compared to the potential gains. Then we have an option to transfer it, that is insurance, or even contracts that shift liability to vendors. For example, cloud hosting liability clauses. Think of a cyber insurance here. After 2014 JP Morgan Chase data breach that hit 76 million households, many banks re-evaluated their insurance cover. They realized transferring parts of the financial risk didn't mean outsourcing accountability. You still own the operational hit. Then there's an option to reduce it. This is where we apply controls, add DDoS protection, patch vulnerable systems, monitor transactions, etc. Take phishing as an example. You might add multi-factor authentication to reduce likelihood. Minimize sensitive data storage to reduce impact. In 2020, Lloyds Banking Group faced a spike in phishing attacks against its mobile app users. Rather than accepting the growing losses, they invested in stronger app authentication and transaction verification, cutting fraud attempts by over 50% within months. Then we have accept it. Sometimes the risk is small, inside appetite, or too expensive to treat. That's okay as long as it's documented and reviewed. Sometimes you consciously accept a risk because mitigation costs outweigh the threat. The key is being transparent about it. One bank in UK chose not to replace a legacy reporting system immediately, accepting the operational risk while planning a phased upgrade. But they documented the decision and monitored the risk until the replacement went live. Banks often combine treatments. You might reduce the risk with controls, transfer part of it without insurance, or accept the rest if it fails within your approved threshold. And in regulated banking environments, every accepted risk needs justification because regulators may ask, why didn't you act? Let's get practical. What kind of controls do we actually apply? First, remember the golden rule. Controls either reduce likelihood, impact, or both. Here's how banks typically think about them. add multi-factor authentication to online banking. This is going to lower the chance of credential threat and in turn the likelihood. Encrypt customer data. That makes it useless if stolen, and hence the impact is reduced. Implement fraud analytics. That is going to detect misuse in real time, which is going to in turn reduce both the likelihood and impact. Controls also come in three flavors. You have technical controls, which are system based, like firewalls and monitoring tools and EDRs, etc. You have administrative controls around peoples and processes, such as policies, onboarding checklists, awareness trainings. And then you have physical controls around data center security, restricted branches, ATM temper alarms, etc. Now, here's the trap to avoid. Don't just throw in best practices because a framework says so. If it doesn't map to a specific risk, it's not GRC, it's simply busy work. For example, don't implement a biometric vault control on the internal HR folder if your risk register says that ransomware in the payment switch is your top concern. Every control must tie back to a specific threat, a known vulnerability. And the treatment goal should be, are we reducing likelihood, impact, or both? So let's finish this module 3 with a big picture view. How do banks actually manage risks? There are two main school of thought. Number one, bottom up. Risk is identified at the system or process level. For example, your GRC team notices a gap in patch management during an audit. That insight flows upward. Then there is top down, in which risk appetite is set by the board or enterprise risk and cascaded down through policies and control requirements. For example, there could be a policy that no system handling PII can go unpatched for more than 30 days. In banking, both matters. Regulators like top-down model. They want to see that the board has defined risk limits and the controls align with regulatory obligations like those from the FCAs and PRAs, etc. But banks also need bottom-up feedback loops, especially as threat landscapes change fast. For instance, frontline analysts might detect an uptick in phishing targeting your call center, a surge in alerts from your fraud monitoring tools, a pattern in third-party risk assessments. These insights must be escalated, and if material, they influence top-down strategy. Most mature banks run in hybrid model. They use top-down frameworks to enforce consistency. Let bottom-up mechanisms highlight exceptions and zero-day surprises.